Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Yardeni of Yardeni Research writing this. Our concern is that lowering interest rates will lead to financial instability. Solid productivity-led growth in real GDP implies that current interest rates are just fine where they are. Ed joins us now for more. Ed, good morning, sir. Is this a market then that you want to lean into?
Absolutely. It's a bull market. It's been actually a bull market since the last recession. The last recession was a 2-month recession back in 2020. Remember, with the lockdowns, we made a low on March 23rd, 2020, and it's been the market's up about basically 100% since then. And almost all of that can be accounted for by earnings. I mean, once the market recovered from the pandemic sell-off and we went back to where we were in February of 2020, we're up 100% since then, and forward earnings are up 100% since then. So it's been actually an earnings-led market with a multiple of around 22.
Ed, your line, our concern is that lowering interest rates will lead to financial instability. What might that instability look like then?
Well, we're just talking about a plain old vanilla melt-up. 2022 is a very elevated valuation multiple. It can be justified by the fact that the economy is growing. It can be justified by the fact that the Magnificent Seven account for 30% of the S&P 500, and they have a multiple of about 30 right now, and the rest of the market's got a valuation multiple of 19. Not cheap, but it's the impressive 493. They're doing pretty well. It's just by comparison to the Magnificent Seven, they look a little punky. But all in all, I think we're still looking at a bull market that continues to maybe 6,600, 6,800 by the end of the year, and 7,700 or higher by the end of next year.
Ed, a melt-up doesn't sound so scary. In fact, Max Kettner would absolutely embrace it and say, let's go. Just like you said, you actually see bigger returns. Where is the pain then? Where is the negative consequence if the Fed doesn't need to cut? Does it come with higher long-end yields that we just aren't seeing yet?
Well, I think as I said in the quote you picked up, we don't really need a rate cut here. And if we get a rate cut, that increases the odds of a melt-up. So whatever targets I gave you, we'd surpass them sooner rather than later. And then the valuation multiple is suddenly at 25. 25 is where the tech bubble burst back in the late 1990s, early 2000. We don't want to go there. And I think that what really is important to understand here is that cutting interest rates isn't necessarily, all that liquidity is not necessarily going to go and create more jobs. I think we've lost 1.5 million people in the labor force who are foreign-born since since March of this year. So obviously the shutting off of the border and the elevated deportations have reduced the supply of labor, and that's not going to change if the Fed cuts interest rates. And by the way, the job openings have been declining in areas that benefited from the inflow of migrants, and that was state and local government job openings really have declined sharply because we don't need as many teachers, we don't need as many social workers, and that's where some of the job losses have been. And that's not going to change just because the Fed lowers interest rates, but we could get more inflation out of it in terms of consumer prices, and we could get higher asset prices, which is fine unless it's a melt-up.
So, Ed, what do you think when you take a look at some of these consumer surveys that show that individuals in the United States think that it's the hardest time to get a new job going back to at least 2013? This idea that you do see a real sense of deterioration in consumer confidence about the labor market. Does that raise alarm bells? Or are you saying that this is a structural sea change that cannot be affected by monetary policy?
Well, if we kind of drill down and look at the labor market report that came out recently, what we know is that where it is very hard to getting harder and harder to get a job is for teenagers and would-be workers who are 20 to 24, mostly people who are coming out of college. So entry-level jobs have become more difficult to obtain. Some of that may be related to productivity. Some of those younger people, you have, a lot of people cross the border, and they weren't old people; they were mostly young people, and they're going back. So I think that's an issue. But for anybody above 25, not anybody, but for people in that category above 25, the unemployment rates are below 4%. They've been there for a while. That hasn't really changed. So it's a very bifurcated labor market.
Ed, when it comes to what's going on in the stock market, though, you have all these tech companies spending a ton on CapEx. It doesn't mean when it comes to these data centers that it's actually creating new jobs. So can we see a melt up in the stock market, but a recession in the real economy?
Well, I think the economy is evolving very rapidly into something different than we're used to. I think we're still kind of looking at the old-fashioned business cycle model where manufacturing of goods is important. That's less the case, and everybody recognizes that services have become bigger. But I think people still haven't wrapped their arms around the fact that we've been in a digital revolution that actually started in the mid-1960s with the IBM mainframes, and here we are now with artificial intelligence, and this revolution is all about processing more and more data faster and faster, more cheaply, and that's what AI is doing. That's what the cloud is doing, and that's a whole new economy, and it has tremendous implications for the future. I've called this the roaring 2020s, and I think it could go into the roaring 2030s because of this digital revolution that we're in that seems to be actually accelerating.
So, Ed, you went there. I'm worried about the 30s, so you help me. This is the situation at the moment. A lot of the gains are concentrated in asset price appreciation. The labour market's weakening. You've got the far left waiting in the wings, making a pitch to this country that they should be running things. And if we see gains in the stock market, but not gains in the real economy, I think capital gains is going to be a big story in the next 10 years. Ed, why should we be optimistic and constructive for capital markets to the 2030s, given the dynamics that are starting to build already?
In a word, productivity. So, for example, today we may very well see that the Bureau of Labor Statistics lowers the level of employment over the past year or so, at least on a preliminary basis, by 450,000 to 750,000 jobs. And everybody's going to interpret that as being a sign that the labor market was actually weaker than we thought. Actually, I think it indicates that productivity is increasing. So what we sort of lose on the headcount side, we gain on the productivity side, and if that's the case, then real wages go up. So all the workers that are out there are going to, on balance, on average, get an increase in their inflation-adjusted wages, and that's where the growth in real incomes are going to be, and that's where the growth in consumption is going to be fueled. And then we've got capital spending, particularly in technology. It accounts for over 50%. Technology accounts for over 50% of capital spending now. That's only going to go higher. And so, again, I think the economy's nature has changed pretty dramatically. I think the stock market has figured it out. And I think it's all good if I'm right about the productivity story.
Stay with us. More Bloomberg surveillance coming up after this. I want to bring in Henrietta Treyz of Veda Partners. Henrietta, I just want to stick on these pictures. And I want your perspective on how these kind of pictures play out in places like South Korea, when their government is getting together and negotiating with Washington to come up with $350 billion investment deals. What do the people of these countries think?
Well, I think the first question that it always needs to be is what are the political ramifications of continuing to side with the United States when they're, trying to forcefully kick out 300 skilled laborers? And that's what it is. So South Korea is doing exactly what President Trump has asked for, investing $350 billion in the United States across these Hyundai plants, electric vehicle plants, et cetera. And then you're simultaneously kicking out the very employees that they need to run said plant. So it's a thumb in the eye across the board. I think it really gets to the heart of the matter that these trade deals the president has announced with various nations, including the EU, Japan, South Korea, none of them have legal text. None of them are finalized. And pending the Supreme Court ruling on IEEPA, I anticipate that most of them are going to get upended in the next couple of weeks anyway. So basically, we do not have a deal with South Korea. We do not have a free trade agreement. Tariffs are exponentially higher than they were when Trump took office. And we had a congressionally passed 0% tariff rate on like 95% of goods coming in from South Korea before this administration took office. So I don't see any material good news here.
And local press in South Korea is saying at the same time the U.S. and South Korea are holding working level talks when it comes to the trade deal. But how can what's happening at Hyundai and this plant impact those negotiations?
Well, I think the issue, as we're seeing in countries across the world now, is that their political leaders cannot enter into binding agreements with the United States for their own domestic political purposes. So it really just is that, thumb in the eye situation that creates an impossible, intractable path for the United States and these nations to come to an agreement. And their political leaders can't have it, just like Trump can't have it.
Does it mean that potentially the United States won't get this $350 billion worth of investments from Seoul?
Absolutely. No question.
So where does this leave the trading relationship?
I don't think that there is a trade deal, and we've already undermined the free trade agreement and overridden it with the IEEPA tariffs. So we have these tacit commitments on things like sectoral tariffs for 232s on pharma, on semis. A critical one for South Korea is one that hasn't emerged yet. That's the lumber and timber tariffs, which President Trump tweeted about being the furniture tariffs a few weeks back. Those are directly targeted at South Korea and Canada. So I don't see an opportunity for this trade deal that they have that allows South Korea to commit to this IEEPA rate holding water. And certainly that $350 billion in investment materializing when South Korea can't put its own skilled laborers that the United States does not have in plants in purple states like Georgia. It's unsustainable.
Henrietta, does this Georgia situation tell us anything about what a bigger priority is for Trump domestically, whether it's limiting immigration or whether it's getting these trade deals done?
Yeah, I think that's fair. Immigration is one where we can say, objectively, the president has succeeded beyond all of his measures, even so much to say that he did it too fast. And now they're targeting these areas where it's job creation and hitting the trade agenda and the investment that he said he wants to see in the United States. But as I mentioned at the outset, these trade deals that we have reached with the EU, with Japan, with South Korea, Vietnam, the Philippines, Indonesia, they do not exist in legal text. And the fundamental underpinning is the 15 to 60% IEEPA tariffs that are in effect across these deals that the president indicates he got these nations to agree with. When the Supreme Court rules that they're unconstitutional, which is something that is entirely possible, and we'll get an announcement about when they're going to take up the case as early as today or tomorrow, then you really have the question of what matters more, the immigration stuff that we've delivered on or the trade deals that don't exist.
And one thing that we were talking about yesterday is it seems like these goals are in conflict, the idea of limiting immigration while also getting certain investments and getting certain trade deals across. I'm wondering if this really speaks to how this is being perceived politically, whether trade deals are complicated politically, but limiting immigration caters to a certain base of President Trump that he will continue to double down on and will come at the behest of whatever trade deals might get through. I'm just speculating. I'm wondering if that's a message or if this is a little bit messier than being stated.
I would say let's go straight to the numbers, because I totally agree with you. Where is the American public on this? The stock market is reacting in one way to all these tariffs, but the American public, and I've said this to y'all for a while, and the polling continues to support it. This is a 60-40 issue, a 70-30 issue that the president is on the wrong side of. 77% of Americans believe inflation is the number one problem. As an overall scale of what their most important issue is, all voters, Democrats, Republicans, and independents, predominantly independents, believe that inflation and high prices are the problem, and they think the president has gone too far. That's the exact Economist YouGov wording of their polling on tariffs. And that's a 54% number as of the latest data. So American voters are incredibly aware of the fact that tariffs are taxes. Prices are higher at grocery stores and at big box retailers. And they do not like it. And that's why you're seeing the president's approval rating so far underwater. So you can get distracted with some of the other components. And of course, there's a healthy population of Americans who very much support the president's immigration agenda. But the economy wins all day, every day. And inflation and prices continue to be their number one issue, and they don't like the tariffs.
Stay with us. More Bloomberg surveillance coming up after this. Oksana Aronov, the head of market strategy at JPMorgan Asset Management, raising concerns, writing, if the Fed thinks the economy should be churning out over $150K a month, that's going to guide them into cutting short-term rates, which is stimulatory for the higher inflation environment we're in. Oksana has made it into the studio, navigating sinkholes of her own through Westchester. It's good to see you, Oksana. Good morning.
Literal and figurative ones.
Thank you for making it. Let's start with this Federal Reserve. What are you actually expecting? So let's make a divide, a big distinction between what you think the Fed will do versus what you think the Fed should do.
That has been a divide for over a year now. We did not believe they should have been cutting last year when they did. We saw the long end react in a way that I don't think anyone anticipated. We anticipated it because, of course, the long end was reacting to realities around technical, supply of treasuries and long-term inflation expectations. And that is the reality, I think, that the Fed will continue to grapple with this time around. Nothing is likely going to stop them from this cut that's coming up this month, even a higher than expected inflation print. And that's unfortunate because I think they would probably benefit from standing still here, looking at what's actually happening in the economy, looking at, variables like what's happening with population growth, for example. We are really not sure, given that, the border is tighter, there are deportations, right? Population growth is a tremendous driver to jobs. And that is changing. And we're not entirely sure how that's changing. And to the comments you quoted earlier from me, if the Fed is still being guided by the economy needs to be churning out 150, 200,000 jobs a month, then that's going to guide them in a direction that's going to be pro-inflationary.
It might not be 150,000 jobs a month, but it's not a contraction like what we saw in June for the first time since December 2020. It's not these surveys indicating that people don't feel good about getting jobs. Why won't that curtail inflation on its own? Why doesn't that suggest maybe the Fed has some room to normalize policy from what might be considered restrictive?
Well, this is really the issue, is that the Fed keeps calling this level of rates mildly restrictive, or restrictive is continuing to be part of their rhetoric. And it's hard to see where is it restrictive, because financial conditions continue to loosen. They're looser now than when the Fed started their hiking cycle, 3-4 years ago. And so, yes, the jobs backdrop is moderating, but the unemployment rate is still, 4.3% versus 4.2% a year ago. Is there some slowing? Without a doubt. That is a natural kind of ebb and flow of the markets and the economy. I don't think this calls for the kind of sort of fever pitch around let's cut. And I'm not sure what cutting is going to ultimately do, because when we cut rates, what are we trying to do? We're trying to improve borrowing costs for small businesses. We're trying to improve borrowing costs for mortgage borrowers. And that's just not really been the case. I mean, mortgages are still kind of stuck in that mid-6, high-6 level, which is not really unlocking tremendous amount of activity. And frankly, even if we give the benefit of the doubt to this policy and say, it's going to improve the mortgage rate, is that really going to yield better home affordability? What is your average homeowner going to do if they know money's cheaper? They're going to raise their home price further. We saw some of the lowest mortgage rates over the last decade, rock bottom low mortgage rates, and all we saw was tremendous price appreciation.
Are you saying that rate cuts here, even if there is some degree of weakness in the labor market, would only inflate asset prices, create long-term inflation, and do nothing essentially for any of those underlying issues?
Unfortunately, I think there's a very significant risk of that happening. It is going to probably stoke asset price appreciation, which is already at a very rich level. We know that credit, and I've talked about this before here, credit has never been more expensive. Credit has been more expensive, 1% of the time historically. 99% of readings in credit over the last number of decades have been less expensive than where it is today. So price appreciation, although I will say if the Fed is aggressive around price cuts, that may actually spook markets, where markets may be like, well, what do they know that we don't know? And that can actually spark a sell-off in credit or in risk assets, which, look, risk assets are definitely pushing some boundaries there, and a correction is not outside the realm of reasonableness or possibility. But I just don't think the Fed has enough here to really be as aggressive as everyone is asking it to be. However, the Fed has done no favors to itself, right? Over the last 18 months or so, they looked political, whether they wanted to or not, when they, for the first time ever, changed policy within a couple of months of an election last year. And that made them look politicized, whether they were or were not. And so that's why I think the market generally is sanguine around this question of, Fed independence. We're seeing markets kind of look through that. Yes, maybe it's a red flag, but until we see the White House actually set monetary policy, I think the markets are going to continue looking through that.
In the 30 seconds we have left, how would you deploy capital? Where would you like to put it in fixed income at the moment?
So this is the most important question, because everyone kind of sits here and talks about what's going to happen in with the economy, what's going to happen with Fed policy. But at the end of the day, fixed income specifically, which is the world I live in, is meant to be a ballast in your portfolio. And the problem that investors continue to have, whether they realize it or not, is that bonds and stocks have become highly positively correlated.
Yep.
And so what I think investors need to do is look at their fixed income portfolio and think about, okay, well, rates fell, maybe I did well, but when rates rose, did I do just as well, or was my portfolio positive? And I think they need to really think about that kind of diversification with investors that can generate returns, regardless of whether the environment is a good one for bonds or not.
Stay with us. More Bloomberg surveillance coming up after this. Setting us up for the big unveil later on this afternoon. Joining us now to discuss is Piecyk of Lightshed Partners. Well, welcome to the programme, sir. In the bond market for a long, long time, they used to call a certain trade the widowmaker. It was shorting JGBs. And ultimately, at some point, things do change. Well, it was the same story for technology. For a long, long time, people betting against Apple were wrong. Are they right to bet against this company now?
I mean, I also heard in your earlier segment talking about these top 10 stocks being dominant. And I remember people telling me that, like, you can't bet against Apple because the money flows into the top 10 stocks are always going to keep it up. And that obviously didn't work. And to your point, there are leaders, historical leaders like GE, that for a variety of reasons are no longer leaders. Obviously not putting Apple in the same camp there, but the bottom line is they're trading at an above market multiple 30 times. Not the highest they've ever traded at, but above market, and growth has slowed down, and there has been obviously a lack of innovation. You were just talking about thinner phones and longer batteries. Is that really innovation in 2025 when Google obviously is pushing forward with AI and agentic AI in a lot of their products?
Yeah, so heroin chic phones don't get it done for you. I just wonder, going forward, what could get it done for you for them to announce?
I mean, this is not really an event that matters as much for Apple anymore, as crazy as that sounds. And frankly, if you look at the stock performance around product announcements the day after the month, it's the day of, day after, month after. It doesn't really move. When it moves is WWDC. Remember the last time the stock really moved was when they promised all these AI features a year or two ago. Obviously, none of those AI features actually materialized, but that's what people care about, the services side of the business and what the progress is on AI. Because in the meantime, unless they announce an autonomous car or some new product category that can give them 10, 20, 30 billion dollars of revenue opportunity, giving us a thinner phone or something with longer battery probably is not enough to have an impact in the market in the near term.
Well, you've come on the show before and said you think that there needs to be a change in leadership, something that is significant to really show some sort of different pathway ahead. What's your outlook? How do you see this developing since they are losing some of their AI personnel to the likes of Meta? They have been lagging behind the likes of Google when it comes to some of these agentic features. What do you think the evolution is going to be for the likes of Apple?
I mean, and this, by the way, this is not a new topic, and this is certainly not, I've covered the stock for a long time, and it's not something that I've been harping on from the beginning. I've been a Tim Cook fan over the years. I think there's a Wall Street Journal reporter that wrote a book about the pressure that the company even felt internally about the lack of, innovation. So what the problem is now is you have this massive transition to AI. So the ability for others to disrupt, whether it's in this product category of phones or a product category that disrupts phones altogether in terms of how we interact with our data, there's obviously real risk. And at the same time, there is not just innovation coming out of the company in terms of new products. And there's no one can suggest evidence otherwise in recent years. The last great products, obviously Watch and even the car project, were with Johnny Ives, who's ironically now working on what possibly could be a competing product with OpenAI.
So what do you think they need to do, Walt?
I mean, they're in a tough spot, probably not allowing or enabling their AI engineers to be poached by Facebook and others would be a good start. Acquisitions can obviously be a way to jumpstart yourself into the area. But again, you started this segment or this portion asking about management change. Sometimes you just need a senior leader that is more product focused, that can drive you to new products, that might be less focused on, maximizing taxes, right? Keeping cash in Ireland, or maximizing gross margin by, all the manufacturing stuff that they've done in China, and someone that can take those chances and push forward and invest the money to get yourself into new products. This is a mega company. I mentioned autonomous cars as an opportunity. There's plenty of other product categories out there that a company with Apple's brand, staff of expertise, right? Great people within the company of Apple, and the balance sheet that they can, I think, get into some new markets.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.